Welcome to the deep dive. Today, we are giving you a masterclass in reading the market's hidden roadmap. Because, well, normally when you use a GPS app to get somewhere, there is this comfortable expectation of precision, you know?
Oh, yeah, definitely.
You type in your destination, a solid blue line pops up on the screen, and a voice just simply tells you, turn right here, it's easy.
Right. It's a completely binary experience.
I
You either follow the line or you don't. The instructions are absolute.
Exactly. But the second you step into the world of day trading, it feels like someone just took a hammer to that GPS.
Oh, completely shattered it.
Yeah. You pull up a chart, and the landscape is just murky. You're staring at the sea of red and green candles, flashing numbers. And, like, for most people trying to navigate it, it just looks like complete diagnostic chaos.
Which is exactly why so many retail traders end up treating the market like a casino. You know, they see chaos, so they just gamble.
You just throw money at it.
Right. But the foundation of the material we're analyzing today relies on a totally different premise.
Yeah.
The market is not chaotic at all. It's actually highly engineered.
And that brings us to what we are doing today. We're stepping into the roles of your trader mentors. We have this stack of highly specific, rule-based source material from the Inner Circle trader.
Widely known as ICT.
Right, ICT. And we're breaking down what he calls Price Action Model 1.
Which is an intraday scalping model, right?
Yes, designed specifically for beginner to intermediate day traders. It basically takes these incredibly complex institutional algorithmic concepts and translates them into simple, actionable steps.
Steps that you can actually execute without just drowning in information overload, which is super common.
Exactly. We're going to decode the footprints of massive financial institutions and build a roadmap to help you navigate a very specific volatile trading window.
The New York kill zone.
The kill zone, yeah. So, okay, let's unpack this. Our mission today is to understand how to locate what's called institutional liquidity, set precise targets, and, well, execute a stress-free scalping model.
But before you can know exactly when to execute a trade, you first need to know where the market is even trying to go.
Right, you have to define the boundaries of the playing field first.
Exactly. And in this specific ICT model, that playing field is defined by a concept called the 20-day IPDA data range.
Yeah, IPDA, which stands for the Interbank Price Delivery Algorithm.
Yeah, the name sounds like something out of a sci-fi movie, honestly.
It really does, like the Terminator or something.
But the mechanical application is actually surprisingly straightforward. You just open up a daily chart and you look back over the last 20 trading days.
And the sources explicitly note here that we are strictly ignoring Sundays, right?
Yes, completely disregard any Sunday candles.
Yeah.
You only care about the standard trading week. So you scan those last 20 days and you literally just locate the absolute highest high and the absolute lowest low.
And that defines your current dealing range.
Right. It is the box the algorithm is currently operating within.
Okay, so once you draw that box around the last month of normal trading action, you basically chop it right down the middle.
Yep, the 50% mark.
And the top half of this 20-day range becomes your premium zone, while the bottom half is your discount zone.
And the underlying logic there is just like regular retail shopping, you know?
Like buying a TV. You don't want to buy a television when it's marked up at a premium. You wait for it to go on discount.
Exactly. So on the chart, you look for opportunities to sell short when the market is in that top premium half. And you look for opportunities to buy long when it drops down into the discount half.
That makes total sense.
Yeah.
But inside those zones, I mean, you aren't just blindly clicking buttons. The source material emphasizes looking for PDA raise and liquidity.
Right. And we really need to translate that jargon because, well, it is the core of the entire strategy.
Let's break it down mechanically then. Think of PD raise, which stands for premium discount arrays, as specific mile markers on the highway between those zones.
Yeah, the sources mention things like order blocks and fair value gaps.
So what is an order block exactly?
Well, to understand an order block, you kind of have to think about how a massive bank trades. If an institution needs to buy, say, €1 billion, they can't just hit the buy button all at once.
Because there isn't enough supply at that exact second, right?
Exactly. They would spike the price and completely ruin their own entry. So instead, they engineer a drop in price. They purposefully push the market down to trigger panic.
Forcing all the retail traders to sell.
Right. And then the bank just absorbs all those retail sell orders to fill their massive buy position. So the last down close candle before that massive engineered rally, that is the order block.
Wow. So it's the literal footprint of institutional buying.
It really is. It's like the smoking gun left on the chart.
Okay, so that's an order block. And what about a fair value gap?
A fair value gap is simply an imbalance. When that bank finally unleashes its massive buy order, the price surges upwards so violently that there's just no time for sellers to participate.
It just shoots straight up.
Yeah, and it leaves a literal gap in the price delivery on the chart.
Yeah.
And the thing is, algorithms hate inefficiency. So they will almost always drag the price back down to fill that gap later on.
Which makes it a perfect mile marker to look for.
Exactly.
So if those PDRAs are the mile markers, liquidity is the ultimate destination. Let's talk about what liquidity actually is, because it's not just some, abstract financial concept.
No, not at all. Liquidity simply means pockets of unexecuted orders just waiting to be triggered.
Like stop losses.
Precisely.
Uh.
Picture a typical retail trader. They buy a stock, and to protect themselves, they place a stop-loss order right underneath the most recent daily low.
Makes sense.
Now multiply that by 10,000 traders. What you get is this massive pool of sell orders resting just below that old low. We call that sell-side liquidity.
And I'm guessing the opposite is true for short sellers.
Yep. If traders are shorting the market, they hide their protective buy stops just above an old daily high. That creates buy-side liquidity.
So they are essentially leaving giant piles of resting money on the chart, completely exposed.
Yes. And what's fascinating here is that the market algorithms, these massive institutional computers, are literally programmed to actively hunt these exact liquidity pools.
Because they need that fuel.
Exactly.
Sure.
They require those resting orders to fuel their next major moves. If an algorithm is tasked with building a massive short position, it doesn't just sell at the current price.
It manipulates it first.
Right. It intentionally drives the price up, above an old daily high, specifically to trigger all those retail buy stops.
Oh, wow. So once those buy stops trigger, the algorithm instantly sells its massive position right into them.
They are literally using retail panic and stop losses as fuel.
It's ruthless, but understanding it gives you your daily bias.
It does?
So if the daily chart has recently broken above a swing high sweeping that buy-side liquidity and is now trading down in a discount zone, your bias is bullish, you want to buy.
Right. And if the daily chart has broken below a swing low and rallied up into a premium zone, your bias is bearish. You want to sell short.
That basically sets your compass for the day. You don't guess the direction.
No guessing allowed.
Yeah.
The algorithm's interaction with those 20-day liquidity pools tells you the exact direction.
Oh, wait, I have to represent the skeptical listener here for a second. Every traditional trading book, every Wall Street doctrine tells you the 200-day moving average is the gold standard for major support and resistance.
Oh, I know.
Or looking at yearly highs and lows. Are we just completely ignoring decades of financial advice here? Why restrict our vision to only 20 days?
It is a huge trap that a lot of developing traders fall into, trying to incorporate way too much macro data. You have to remember the strict goal of this specific model.
Which is intraday scalping.
Exactly. We are looking to capture quick, precise moves of 15 to 20 pips. The institutional algorithms that dictate these short-term movements prioritize recent data to frame their immediate draw on liquidity.
Because they need the liquidity that is sitting there right now, not some order from 6 months ago.
Precisely the point. If you look back 6 months, or try to respect a 200-day moving average on a 5-minute chart, you create massive information overload.
You start seeing things that aren't there.
Yeah, you see phantom support and resistance lines everywhere. It just paralyzes your decision-making.
So the 20-day range purposefully acts as a set of blinders.
Right. It keeps your focus razor sharp on what the interbank algorithm is doing right this second.
Keep the lens tight. I really like that. Okay, so we have established the where. We know how to find our 20-day range, check if we're in premium or discount, and find our bias.
So now we transition to the when.
Yeah, because knowing the direction doesn't mean you just jump in whenever you feel like it.
Absolutely not.
Yeah.
The timing is arguably the most rigid, unforgiving rule in this entire model.
The source material focuses execution exclusively on a time window known as the New York kill zone, right?
Yes. This strict window opens at 7 a.m. and closes at 10 a.m. local New York time.
Why those specific 3 hours, though? Like, what makes them a kill zone?
It comes down to global market overlaps. Between 7:00 and 10:00 a.m. New York time, the London session is preparing to close its trading day, and the New York session is just firing up.
Oh, I see. So you have the two largest financial hubs in the world actively trading at the exact same time?
Exactly. This massive injection of volume creates intense volatility. Algorithms use this specific window to manipulate prices, sweep those daily liquidity pools we just talked about, and establish the true trend for the rest of the day.
Now, the sources do mention it can sometimes stretch to 11 a.m., right? Like if there's a late morning economic news release.
Yeah, like crude oil inventories
Yeah.
or a Fed speaker. Under those specific conditions, the window extends slightly to accommodate the news volatility.
But 7 to 10 is your primary battleground.
Always. And the rules aren't just limited to hours. They apply to the days of the week, too. Monday, Tuesday, and Wednesday are the prime days to trade this model.
And Thursday?
Thursday is acceptable, but only under the condition that the weekly liquidity hasn't been swept yet, meaning the market hasn't reached its obvious major target for the week.
And Friday?
Friday is a strict no-trade day. Just do not open your charting software.
Wow, really? Just skip it entirely.
Completely. The algorithms often use Fridays to balance the books, which results in this choppy, unpredictable price action that will just destroy scalping models.
Okay, so inside this high volatility 3-hour morning window, Monday through Wednesday, you stop looking at the daily chart entirely.
Right. You drop all the way down to a 5-minute chart. You are hunting for one very specific mechanical pattern inside that 5-minute window.
And here's where it gets really interesting.
Mhm.
We are looking for what ICT calls the optimal trade entry, or OTE.
Yep, the OTE.
But how do we actually spot it? Like if the market is moving super fast during this kill zone, how do we know exactly where to jump in without, catching a falling knife?
You have to watch the narrative unfold. First, you observe the momentum that was created overnight during the London session. Then during our New York kill zone, you wait for the market to aggressively push against that London momentum. This creates a brand new morning swing in price.
So instead of a surfer waiting for a wave, which is a bit cliche, think of it more like a giant institutional slingshot.
That's a great analogy. The algorithm isn't just reversing the trend nicely. It's aggressively pulling the price backward, creating tension, specifically to gather up resting retail orders.
Right, before it snaps and releases the price in the true direction of your daily bias.
Exactly. That slingshot tension is the retracement.
Oh,
Once you identify that new morning swing, you pull out a Fibonacci retracement tool on your platform.
And you anchor it from the absolute start of that new morning swing to the absolute end of it.
Correct. The entry point, the exact moment the slingshot is pulled back to maximum tension, is found explicitly at the 62% retracement level.
Not the 50% halfway point, not a deep 70% dive, exactly 62%. Why that specific mathematical level?
Because algorithmic programming relies on thresholds of human pain. At a 62% retracement, retail traders who jumped on the initial momentum start feeling maximum anxiety.
Oh, because it's pulling back so far against them.
Right. Their stop losses get triggered, providing the exact burst of liquidity the algorithm needs to execute its reversal. It is a completely engineered trap.
But the source material outlines a crucial mechanical adjustment you must make before placing your order.
Just spread adjustment.
Yeah. If your bias is bullish and you want to buy that 62% retracement, you do not place your order exactly on the line. You have to add 5 pips to it.
That adjustment accounts for the broker spread. Every broker has a small gap between the bid price and the ask price.
Right, so if you fail to add those 5 pips, the market might perfectly kiss the 62% algorithmic level, but your broker won't actually trigger your entry.
And you'll be left just watching the trade leave without you. Conversely, if you are selling short, you subtract 5 pips from the 62% line to ensure you get tagged into the trade.
Okay, let's talk about the nightmare scenario, though.
Let's hear it.
I'm at my 20-day range. I wait for the New York kill zone. I spot the slingshot retracement. I calculate my 62% perfectly, adjust my 5 pips for the spread, and I get into the trade.
Okay, sounds good so far.
And then the 5-minute candle just violently spikes right past my line and blasts through my stop loss. I'm totally out of the trade.
It happens to everyone.
But a minute later, it looks like the setup is still valid. Do I immediately jump back in?
The source material is remarkably strict on this specific scenario. It is an absolute one-and-done rule. If your stop loss is hit, there is zero revenge trading. You do not re-enter for the remainder of the day.
That requires an almost unnatural level of discipline. I mean, most traders want to immediately win their money back.
Which is exactly how accounts are completely destroyed. If your stop gets hit, it communicates one of two things.
What are they?
Either the underlying algorithmic momentum for that session is completely shifting, or your analysis of the institutional intention was just plain wrong.
So trying to force a second entry out of anger will just completely fracture your psychology.
Exactly. You accept the minor loss, you close the laptop, and you return the next day with a clear head.
Managing your mindset is clearly just as important as managing the chart. Which brings us to the next phase. Let's say the slingshot behaves perfectly. We enter at the 62% level and the trade starts surging in our direction.
That's the best feeling.
But entering the trade is only the beginning. Now we transition from trade execution to trade management. We need to talk about setting targets, locking in profits, and, protecting the account equity.
This phase is where developing traders typically fall apart. They endure the stress of finding a great entry, but once they are in profit, they freeze. They just have no exit plan.
Yeah, your daily price targets cannot be based on random financial goals like, I need to make $200 today to pay my car bill.
The market absolutely does not care about your bills.
It certainly doesn't. Your targets must be rooted in the logic we established in segment 1. You look back at that 20-day dealing range.
Right. If your bias is bullish, your ultimate target for the trade is an old previous daily high. If your bias is bearish, your ultimate target is a previous daily low.
Because the algorithm is magnetically drawn to those specific levels to sweep the resting liquidity.
Yes.
Yeah.
But the model doesn't teach you to just hold your breath and grip the entire position until it hits that final target.
No, it outlines a highly mechanical method for scaling out of the trade, which means taking partial profits along the way to secure capital.
And those predetermined levels for taking partials remove all the emotion from the exit. You take your very first partial profit exactly at the anchor point of your 5-minute setup.
For example, if you bought the retracement, your first target to take some money off the table is the top of that initial morning swing.
Exactly. The exact point where you anchored your Fibonacci tool. Securing that first piece of profit is just a huge psychological relief.
So what about the second partial?
The second partial profit is taken at that previous daily high or low you identified on the 20-day chart. The main liquidity draw.
Oh, okay. And if you are using the Fibonacci tool, this target perfectly corresponds to the extension 2 level.
Yep. And finally, if you still have a small piece of the position running, you close the entire remainder of the trade at what the source defines as a symmetrical swing extension.
Mechanically, you measure the total pip distance of your initial morning setup range, and you just double it. It's a measured algorithmic projection.
While managing those targets, you also must mechanically manage your stop loss. At the moment of entry, your stop loss is placed exactly 5 pips below the anchor low if you're going long, or 5 pips above the anchor high if you're going short.
And adding those 5 pips is crucial to avoid getting prematurely stopped out by a random broker spread fluctuation.
Definitely. This brings up a really bad habit a lot of amateur traders have.
Oh, I know what you're going to say. The second the trade goes into profit by a few pips, they panic and immediately move their stop loss to break even.
Because they are completely terrified of taking a loss. And by doing that, they choke the trade. The algorithm needs room to breathe as it delivers price.
Right. The critical rule in this model is that you do not touch that stop loss until you have secured that very first partial profit at the anchor point.
Only after you've taken money out of the market do you move the stop loss to lock in a guaranteed 5 to 10 pips of profit on the remainder of the position.
If we connect this to the bigger picture, this entire model is built around capital preservation and psychological safety.
That's the real secret sauce. By locking in a partial win as soon as the immediate setup validates itself, you completely eliminate the anxiety of watching a winning trade reverse and turn into a loser.
And that framework of capital preservation extends directly to the overall risk algorithm of the model. The source dictates that you must calculate your position size meticulously.
Right, so that you are never risking more than 1% to 1.5% of your total account equity on any single trade setup.
It essentially guarantees longevity in the market. You could lose 10 trades in a row and still have 90% of your capital intact to fight another day.
It's all about staying in the game.
But speaking of streaks, I found an observation in the source material that felt completely counterintuitive when I read it.
Oh, about the winning streaks.
Yeah. The text outlined the strict rule. If you hit a winning streak of 5 trades in a row, you are required to cut your risk per trade in half. So you drop from risking 1% down to 0.5%.
I know, it sounds crazy.
Why on earth would I shrink my position size when I'm clearly on a hot streak? Shouldn't I press my advantage when I'm perfectly in sync with the market?
It feels incredibly wrong, doesn't it? It violates every human instinct to back off when you feel invincible.
Yeah.
But the rationale here is deeply rooted in statistical mean reversion.
And more importantly, human ego.
Exactly. No matter how flawless the strategy is, a losing trade is always mathematically inevitable. If you successfully execute 5 winning trades in a row, statistically speaking, you are standing dangerously close to a loss.
And when you win 5 times, you develop a bit of a God complex. You start feeling like you just can't lose, so you might naturally be tempted to risk even more.
which is exactly when the market humbles you.
Mhm.
By mechanically having your risk after a hot streak, you are preemptively softening the blow of that inevitable loss.
It basically prevents a sudden, massive drawdown from destroying the beautiful, smooth equity curve you just spent weeks building.
Because a massive financial loss right after a winning streak is psychologically devastating. It triggers revenge trading almost instantly.
It's essentially a shock absorber for your account, and the rule applies in reverse too, right?
Yes, it does. If you take a full stop-out loss, the risk on your very next trade is cut by 50%.
You only return to your standard 1% risk once you've successfully recovered half of that previous loss.
It prevents the massive ego-driven highs, and it catches you during the devastating account-blowing lows. It forces you to prioritize discipline over your raw emotional instincts.
So what does this all mean for you? We started this deep dive promising a masterclass in reading the market's hidden roadmap. And when you put it all together, the beauty of this ICT model is its profound mechanical simplicity.
It really is elegant when you strip it down.
Your 20-day range sets the stage and tells you exactly where the liquidity is resting. The New York kill zone rings the starting bell, injecting the volatility you need.
And that slingshot 62% retracement against the London trend is your precise cue to act.
You secure your partials, you respect the 1% risk rule, and you completely remove the desperate need to guess what the market is doing.
But there is one final, non-negotiable reality check attached to this model. The source material strongly insists, like almost demands, that you only practice this entire process in a demo account with fake money for months before ever funding a live account.
Which is naturally the last thing most people want to hear. Everyone listening wants to pull up a chart and start making real money tomorrow morning.
Human impatience is pretty universal, but I want to leave you with a final challenge to mull over today. Think about why the creator of this highly profitable model is so adamant about using a demo account first.
It isn't just to protect your wallet while you figure out which buttons to press on your broker's software, is it?
No, it is strictly to protect your psychology. When you trade live, hard-earned money, your ego, your deepest fears, and your greed instantly hijack your brain's frontal lobe.
You start manually moving your stop loss out of fear. You take revenge trades out of anger.
You completely ignore the 62% rule because you just, quote-unquote, feel like the market is going to go up.
You stop following the clear blue line on the roadmap, and you just steer your car right into the muddy waters because you arrogantly think you know a shortcut.
So the provocative thought is this. How much of day trading isn't actually about outsmarting the market or finding the perfect algorithmic indicator, but simply about out-disciplining your own human impatience?
That is a great question.
If you cannot strictly follow these simple mechanical rules in a demo account where there is zero financial pressure, what makes you think you will survive the algorithmic crossfire when your real-life savings are on the line?
That is a stark but absolutely necessary reality check. The roadmap to finding institutional liquidity is real, and it really works, but only if you have the mental fortitude to stay on the road.
Stick to the rules.
Thank you for joining us on this deep dive. We strongly encourage you to pull up a daily chart, frame out those 20-day ranges, and start looking for these massive algorithmic footprints. But remember, keep it in the demo account until you have fully mastered yourself.